Hey guys, this is Vic from Grasping the Market and welcome to our market briefing. Today we have no marginal change on the larger time frame as we traded under the new all-time highs made earlier in the week, and we're still significantly above last week's range. You can see on the monthly that we traced back to that 30-32 area, which was the previous all-time high for a while, and now the market is kind of struggling to extend consistently or to hold the gains way above that. So tomorrow we come to month end, and it would be very interesting if we manage to close outside or back below that reference. Um, on the continuous chart, you can see that the gains that were achieved after the FOMC press conference overnight. I mean, actually, yesterday in the runoff period, you had an extension with a rejection. This looks like laggard buying, immediately rejected, and the overnight was continuously under pressure. When we opened, there was a little bit of a pullback in the European session, but when we opened, the market was immediately under pressure and went below the 200 moving average, finding value around the 24 to 30 area. Now, if we look at the market profile, you can see exactly that. Remember that the focus was on the upward distribution created after the FOMC. The market basically shrugged a dovish FOMC and went higher. Perhaps the positioning, I mean, the market was expecting a much more hawkish rhetoric from Fed chairman, and because it didn't get it, then there was a little bit of a squeeze, and short position have to be closed, creating this late rally and a subsequent upward distribution. Now, it seems that the momentum traders joining that rally took it a bit too far, and the market went with laggard buying, and when it was immediately smacked down. So on the overnight was under pressure. When we opened this morning, you can see two ticks above the open and immediately driving down, closing that double distribution that denotes change immediately. And the market went back inside the core value, well, the value area from Wednesday. Now, the important thing to highlight here is that yes, the market was under extreme pressure in the morning, but struggled to get a significant extension from Wednesday's low. If you have a market with this amount of single prints in a tail, so basically a selling tail, two ticks overlap and then continues, you go from 44 to 23. That's 20 plus handles if you move that in a straight line. And then after a significant backing and filling, you try two, three times, and you cannot get that extension. The chances are that the inventory is too short, and in my opinion, that's what created this late move. This is a short squeeze. It has all the characteristics of a short squeeze. So yeah, basically the market, I mean, the momentum sellers attempted to take the market lower and make all those buyers or some of the buyers from the late FOMC rally bail and give way on this area. They couldn't do it. At the end of the day, remember that tomorrow we have non-farm payroll, so nobody wants to hold positions ahead of that key risk event, especially after what the FOMC said, that now they're data dependent, and the non-farm payrolls employment report is one of the key things that they will be looking at to decide if they should alter their monetary policy or not. So three times, nobody wants to take home those short positions, and they bail, and that created a squeeze. So focus for tomorrow, definitely. Now we're looking at a 4-day balancing range structure around the low of the range, which is the 320, 30-20 area, is not that strong. Definitely we want to see if there is continuation from this move. I doubt it because it looks like it was a squeeze. But let's see. I mean, the focus is if you get acceptance below this low, that increases the odds of further downside. Within this range, we're basically holding. Remember that we're very close to all-time high, and there is a very weak excess at the top of only 2 ticks. So that suggests that the market may not be done to the upside. So trade well. I suggest you enter you enter into this risk event, the non-farm payrolls, with a flat inventory. It's not very easy when you enter with a bias or a position into this because the volatility will be quite high.